We're going to pick up our two-part conversation with John this week here on the podcast about the other parts of life insurance we didn't cover on the last one. The basics that you need to know, every retiree needs to know. We're going to get into part 2 right now.
In football, the red zone is where a team has to make small adjustments to ensure victory. As you approach retirement, you also need to make small adjustments to ensure success. This is the Red Zone Retirement Program with registered investment advisor and enrolled agent John Mears of Mears Money Management.
Hey everybody, welcome into the podcast. It's Red Zone Retirement Program, Simple Investing, Smart Future with Coach John Mears and myself. And that little intro there I did, John, I felt like Chuck Woolery, man. We'll be right there in 2 and 2. We're going to get into this conversation. We're going to do the second part of our insurance chat.
Try not to bore all you people, but this is important stuff.
Yes. It is important stuff. We were laughing because we got a message that said, good conversation, good topic, but you talk too long. So I think Coach has got a new way to answer these this week. So we're going to see how
just going to go, insurance good. Yeah. So
insurance good. Get some.
Yeah.
So anyway, we're going to get into the long term.
Yeah.
What are you going to do, right? I mean, sometimes you just start talking and things just happen. So, all right. So let's talk about long-term care insurance, Coach. Let's jump into this one here. This one will be a little bit longer, I think, than the second part of this. And we'll still try to keep it somewhat shorter from Mike, who sent that message. Thanks, Mike. We appreciate you listening. So anyway, what's the reality, Coach, of the long-term care situation right now? I mean, to me, it doesn't seem good out there.
You're going to need it. That's just the reality of it. There's
long-term care good.
Yes. So the numbers do bear this out. So I've got my notes here. So if I glance off screen here, just kind of bear with me here.
Go for it.
It shows that half of men and 2/3 of women are going to need it. So
that's not as bad as I thought, though, Coach. Yeah. Half? I really actually thought it'd be higher than that.
Yeah, that's still a lot, though.
It's a
lot. 50-50 coin flip if you're watching this. So between you and me, I will need it and you won't, or vice versa. So,
oh no, dude, it's gonna be me. Don't worry about it. It'll be me all day long.
So, but the reality of it is, anybody listening to this and you're with us, you have a spouse, one of you is going to probably need it, and if it's your wife, the odds are 2/3 of women are going to need it, and we're living longer, we're staying healthier longer, but the medical advances are prolonging our lives, which is
great on the body, but it's this that winds up being the issue, and then that's when the De Niro really raises up, right?
Yes,
because the long-term care coverage for mental issues, Alzheimer's,
it can be a decade. Yeah, it could get longer, and that's where we have to kind of start knowing and having a plan. So this is why we are discussing this. So.
All right. So if that's the reality of the situation, then what's the why behind it? Well, let's just jump right into the big why. Most people go, screw that. I can't afford it. Mm-hmm. I literally can't afford it.
So that is something that I do address here as far as affordability. And one of the things that advisors will always say to a client, I can't, it's expensive or I can't afford it. And I always say, well, compared to what? Because if you're having to spend money, long-term care, in California, it can be quite expensive. You're looking at, I'm just trying to think off the top of my head with people I'm working with. It's $40,000 a year, easy, and that's kind of a bare minimum with long-term care. If you have any kind of a more advanced facility, a little bit better care, it's just going to cost more. And
here, Coach, I got notes. I got numbers for you. So $40,000. So 2024 home care, 44 hours per week, $72,000.
Mm-hmm.
Okay. So we'll pop that up on the screen for folks. Assisted living facility, $72,000.
Yep.
So, and then nursing home, private room, $130,000.
That's where I was going to get to. 6 figures is easy, especially here in California.
Yeah.
So it just keeps going up, and I'm probably aging myself by using numbers in the 40s because that's probably the last number I put on a tax return. But
that's when you were born, so it's okay, right?
Yeah, but it's just going up and up and up, and it's just something that is again, you're going to need it, and we need a plan for it. So the question then becomes, how are we going to pay for it? So generally speaking, when I'm talking to someone about long-term care, we are going to explore perhaps the possibility of long-term care insurance. But if not, if you cannot or don't want to pay for long-term insurance, we do have to have a plan as to where is this money going to come from. Now, that becomes the next step here. And with our notes here, I don't know if I'm kind of jumping all over the place, but one of the things I tell people is we can, if you have the savings and investments, you can use that. That can get depleted pretty quickly, but if it's there, we can use that.
So you're talking self-funding.
Yes,
but you could run out quick. And if it happens to me, then my wife could be screwed, right?
Correct.
Kind of thing for retirement.
The first person to use it leaves the bucket a little bit emptier for the second person that may need
probably
it.
not the best option.
No, but it is an option. We have to discuss that. That's something we have to kind of go through. Mr. and Mrs. Smith, these are your choices here, and this is what may or may not happen here. And then another choice is the equity in your home. Now, whether we're trying to avoid selling the home. We've talked about this in previous episodes, using the home equity conversion mortgage, using basically reverse mortgage.
The reverse mortgage.
So you're getting money out that you don't have to pay back. Generally, if you're over the age of 62, you can take out, call it 30% of whatever the value of your home. So here in California, it's not surprising to have $1 million home. So you're talking about $300,000 you might be able to access. And that's something you could do, is try and access some of that rather than selling your home, doing some sort of equity line out of your house. That is an extreme step if you have to sell your home. But again, that is still an option. If you say, by the way, if one of us goes into long-term care, the other spouse will just have to recognize that we may have to sell the house, and they'll have to find another way of living. And so we'll have to take out the excess that we have in the home. Again, $1 million home. You have $1 million, not counting taxes, that you'll have to use for long-term care. But I just want to have a plan. So when you go through all these, then sometimes when people hear that, all of a sudden long-term care insurance doesn't look quite as onerous, if you will. They're like, okay.
If you get covered, though, Coach, there's some reasons why you may get disqualified too, though, right?
Mm-hmm. Yeah. One of the obvious ones is that you may have a pre-existing condition, and they may not be able to give you the long-term care insurance. This is not regular medical insurance where they can't deny you. This is something where they can. So you want to make sure that you do get your insurance when you are insurable, if you will. So
like this guy right here, right? So open heart surgery, looked into it, in my 40s, and they were like, nah, you know what I mean? So, and I was like, well, that's still 30 years from now. Give me a chance,
but that's right. If you have a pre-existing condition, they can deny you, and that's kind of the main reason why they may disqualify you. There are other things that can get into disqualification, but that's the main thing right there is actually the health.
Which would make sense, right? So, and I think the biggest takeaway for this, and I did jump around a little bit when I asked you about it being expensive, because I knew that was going to be the number one thing that most people shy away from it, because they're just so costly that once they see some of the numbers, they go, I can't swing that. So what's the point in even talking about it? And I think that's the crux of the conversation, because I talk to advisors all across the country, Coach, and you know that. And the majority of advisors I talk to see people every week, and almost always they're not having the conversation with each other, like the married couple, right? So you got to start at some place, because it's the very sweet and very noble, conversation of, well, we're going to take care of each other in our old age. It is not realistic. You know what I mean? I mean, think about it. Like, Coach, your wife can't pick you up if you are down on the floor, you know what I mean? And my wife can't pick me up, and it's only going to be worse when she's 70.
Yeah. And that's where we start getting into the continuing care retirement communities, where there may be a certain level where you start graduating from, basically no care or basically independent living, but you're in a community, and then it starts getting to minimal, modest, and then full care. Those are things to consider. Now, those can also be expensive as well. We've talked about that in a previous episode, but that is an option where you can kind of do what they ask for is a little bit of a down payment, and then you start making monthly payments basically to live there. But you can kind of graduate down the spectrum. But that helps with that spouse, like you said, where they just can't do it. And
and it's such a taxing thing too, right? I mean, it's a lovely sentiment to say you're going to care for your loved one, but I mean, come on, it's anybody who's ever done it knows how physically and mentally exhausting it is.
It is. When we're talking about the activities of daily living, the ADLs, that includes bathing, which, let's face it, we just don't want to be doing it. Going to the bathroom, feeding, somebody, again, that just can get exhausting. And again, we it sounds romantic that we're going to do that, but the reality of it, it's like when this is probably a bad analogy, but I remember when I first bought I bought my first home 30 some odd years ago, and I wanted to do do all the yard work. I want to cut the lawn and do the lawn trimming and all that. And that lasts about, I don't know, a month. And then I just was tired of it and I wanted to hire a gardener. The same thing maybe as far as helping a loved one, where you may say, I can do this. And then after a month or so, it just becomes draining. And that's why we have, and somebody that's probably more qualified and more able to help in this situation as well. So that's why we want to consider that. And again, it's for the loved one. One thing I point out, and we're going to get to this here in a minute with life insurance, the fact of the matter is with every married couple, one of you is going to die alone. That's just what the reality of it. One of you is going to outlive the other. And so we have to be always thinking of the single person in the future. We think right now we're always looking at the couple, and we have to always think when we're planning, what about this Social Security planning? What about the single person down the road? Because we forget about that part of the equation.
Yeah, no, that's a great point. And it's odd. My wife will say sometimes, unless you're lucky enough to go at the same time. And first you hear that and it hits the ear weird and you go, that doesn't sound lucky at all. But, from the standpoint of her saying, you get to go together and then the other person doesn't have to go through all that and be alone and stuff like that. And it's like, yeah, I get it. There's a romantic sentiment in there as well. But the reality is that, yeah, typically one person outlives
So
together.
there will be one person that's going to be on their own is kind of where I'm trying to get to here. So we think about one spouse maybe helping the other spouse, but when the other spouse is gone and the remaining spouse is getting older and needs care, who's going to do that? That's really the big question. And asking kids that are probably still working to try and chip in and do that, I won't say it's selfish, but it's a very big ask to have people, stop what they're doing to help you. And so it's something where we have to kind of plan on how can we be the least burdensome to our family as we get older. And that's why we have this. This is why we have this conversation.
Well, and nobody wants to be a burden on their kids. I mean, well, maybe. I guess if your kids were a real pain in the ass, I guess maybe you're like, I'm gonna turn around and give it right back to them.
Yes.
All right, so let's jump to life insurance then, and actually life insurance products as well. I'm gonna tie it into this way because you could look into an annuity as a possibility because there are different kinds of riders and things, right? Got me thinking about that when you were talking about the activities of daily living. I know that there's some ways you could also use some of that for long-term care as well, correct?
Correct. And that's where we can tie life insurance planning into what we're doing with long-term care planning, because there are so many different things we can do with life insurance. We have term insurance really isn't designed for that, but you could. But really, when you look at life insurance, you're trying to develop some sort of a plan. And I will use life insurance as a planning vehicle to also supplement their retirement income at some point. And I call them like these super Roths where it's not deductible. We can contribute as much as we want. And then we can actually pull money out in the form of loans or whatever down the road. But yeah, you could use these to supplement your long-term care. And remember, long-term care doesn't have to be one size fits all. We could have a little bit here, a little bit there, and a little bit there to kind of fill in all the blanks here to get us to where our intended goal is. So it may be some insurance, or it may be a little bit of equity, a little bit of savings, and a little bit of life insurance to get us to that end point. So life insurance is a great tool to consider for long-term care.
Okay. If it is needed, right? So the question around it, a lot of times the question will come back, this is even just regular life insurance, especially for retirees. Do I need it at this age? And if I do, how much, right? So again, that's something you can be working with your advisor through and saying, okay, is it even right for me? Because every situation is going to be different.
Yes, everybody is totally different. And so that's where we are doing our, discovery phase. Where we're just kind of gathering information and trying to determine a plan. That is one of the things we have to figure out. Now, I will tell older people, if you are still carrying a mortgage, then yes, there's probably likelihood that you should have some sort of insurance, even if it's just mortgage insurance, if you will, but you should have some sort of insurance so that your spouse isn't left holding the bag, so to speak. So you want to have some sort of insurance. There may be, if you have a pension, there's a great way so people are worried when they're taking a pension, whether they take 100% for themselves, 75%, 50%, and how much is going to be left for the spouse. Insurance is a great way to kind of cover up that and say, okay, by the way, if something happens to me, the insurance will take care of that, whatever that shortage is here. So if you have a pension, and sometimes people come to me, they've already made those pension elections, so it's too late. Well, then this is what we can use as insurance to kind of cover up for that. I'm taking 100%, my spouse gets nothing if I die. Well, Okay, so what are we going to do here? We want to make sure we prepare for that so we can use insurance in that area as well. So there's ways we can calculate the insurance. And then again, retirement and or long-term care, those kinds of things will kind of build into that. But insurance is a great product. It really is. I know that some people get scared by insurance and they think it's all evil, and it's not. There's a reason why it's a big industry. If it's used effectively and used correctly, it's a fantastic tool to use for your financial planning when you get into your retirement years.
And we didn't even touch on cash value policies that could be really helpful in some of these areas as well, right? Yeah. So, I mean, a lot of times, folks, a lot of people that, are doing quite well in life, they carry a lot of insurance. There's a reason for that, right? Especially in different kinds of policies, kind of create your own bank, if you will.
Yes, absolutely. And I work with different insurance designs for different needs that people may have. And again, there may be a situation where the cash value, again, could be a supplement to retirement. We also may still have a business. I run into people that they're older, they have a business. Maybe they're not running it day to day, but again, there's equity in the business. And so we need to be prepared for that. There's so many reasons to have life insurance, and we haven't even touched about on annuities. And there are certain situations where you may take a portion of what you have and buy a single premium annuity where you start taking payments out right now to kind of bridge that gap. Having fixed income, having steady, reliable, guaranteed income is a huge benefit to many people. So they're getting their Social Security, they have a pension, and having another bridge there. And then anything beyond that can be their fund money. But if you have this fixed income that is covering all your needs, that's a great way to plan in the long run too. So there's so many. This is why you got to talk to an advisor. I really do believe that. There's so many different things you can do with life insurance. That alone could be worth talking to an advisor about. So
John has a couple of free books, Diffuse and Tax-Free Retirement in California, that reveal exactly how you can experience zero taxes in retirement and overcome the IRS lien on your 401k, IRA, and 403b, which could threaten your future lifestyle. These are complimentary, so all you have to do to pick these up 100% free is just stop by rescuemyretirement.net. That's rescuemyretirement.net. Fill in the basic info and he'll ship those out to you immediately. That's rescuemyretirement.net for a copy of Diffuse and Tax-Free Retirement in California. All right, what we got is Travis, and he says, hey, John, I'll be receiving a settlement from a medical malpractice lawsuit within a month or so, a couple of months, and I have some credit card debt and some car loans, so more than one car, that could be paid off entirely with the settlement, or I could invest the money. Any recommendation for a dude like me?
Yes. Again, a great question. This is unfortunately not that rare of a question that I get. When I had my large tax practice, I probably had a couple times a year or somebody coming in with some sort of a decent sized settlement. The first thing we would always have to look at is what are the tax characteristics of the settlement. So we'll set that aside for right now, assume that it's all going to be tax free for whatever reason. And so if it is, I would talk to Travis and say, I would want to do a full analysis. I wouldn't want to say, let's just go ahead and pay everything off, which is kind of my instinct, but there may be reasons why we don't. I would want to see what's going on with the other side of your financial planning with retirement.
Right. I mean, age could factor into this, right, Coach? Obviously, depending on what you're going to do. But yeah, I mean, the default would be high credit card debt, especially with high interest rate and possibly higher car loan rate notes would make sense to go ahead and get rid of that higher debt versus investing. But what if Travis, if you got nothing set aside for retirement, that could change the conversation, right?
Correct. We would want to see, first of all, what are the interest rates on some, sometimes people have a vehicle loan through the credit union, which is zero or very low interest rate.
Yeah, his car might be 3%, but that credit card might be 29.
Yeah. So we'll take a look at everything, Travis. It's a great question. So we'll look and see where we should go with that. Again, the initial knee-jerk reaction for me always is trying to get out of debt. I think when we're trying to do long-term planning, people don't understand. It gets a little difficult to explain this to people, but you're saving at whatever that interest rate is that you're paying off. So if there's a 29% credit card, we'll use that 20% credit card. You're actually saving at a 20% rate because you're not paying that interest anymore, and you are and that is outflow. So you're actually saving at that rate. So yeah, we want to make sure that we can pay off our debts. That would be my initial reaction here, but I don't want to do a full analysis. Again, we talked about in other episodes doing the discovery phase, trying to find out what's going on in your life. I know that sounds boring. I get it, but that is something that we have to do to find out. So we can do, I take it very seriously and I want to be able to do the best job possible for you. So I need to know all the information we can. So there may be issues with kids getting ready to go to college. There may be something where you're either close to retirement, not in retirement. Your house may be close to being paid off. There could be a million things we want to do with this money. So just saying, hey, do I do this A or B? It may be A, B, C, or D that we may want to be doing. And so that's why I would like to find out more from you, Travis. But it's a great question. It's I hope you're okay with whatever this medical settlement malpractice was for. But but let's make the best of it and let's do this wisely and prudently. And the only way to do that is actually look at your entire situation.
Yeah, I mean, it's a good point because if he's, 65 and he's getting this and he has, no emergency fund and a little saved for retirement, well, that could change the conversation completely. What if he's 35, right? And, and he's not put anything aside yet for retirement or is, is not even on the horizon anywhere near it, then, all of that could just change like that, right? Depending on some other scenarios. But I think it's a good place to have your mindset defaulting and going, hey, especially if I got really high debt, the credit card thing probably is going to be a pretty sure, feels like it seems like in today's market, it'd be a pretty sure thing.
Yeah.
Because it's probably out of control anyway. So depending on what it is, right? If you've got $20,000 at 30% interest, yeah, you probably want to dump that thing off.
Yeah. Yeah. And again, we're going to lean towards that too here. I mean, that is our knee jerk reaction and we're going to lean to that. So yeah, the possibility here, Travis, is 80%, 90%. Yeah, we're going to pay off the debt, but there's just a little bit more I always want to know. And so I just want to ask a few more questions here before we just say, yeah, let's just write the check and get it done with. Because once you've committed an act, it's very difficult to pull that act back. So
can't put the toothpaste back in the tube.
Great question. So it really is.
All right.
Question.
Thanks so much definitely. Thanks so much for listening to the podcast and hanging out. We appreciate it. Don't forget to subscribe to us on Apple or Spotify for audio form or YouTube for video form as well. And you can find all of that at mearsmoney.com. That's John's main website, mearsmoney.com. Lots of good tools, tips, and resources. You can also just simply type in Red Zone Retirement Program into the search box of whatever app you want to find and find it that way. Hit the little subscribe and a little thumbs up there on YouTube for notifications. And we'll see you next time on Red Zone Retirement Program, Simple Investing, Smart Future with John Mears. Thanks, Coach.
Thank you. Good talking to you.
Advisory services offered through Mears Money Management, Inc., an RIA registered in the states of California and Texas. California Department of Insurance License number 0685203.